and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We got 1 hour to go until the market close, so we want to check on what's going on in stocks today. More selling is what's going on. In short, we've seen deterioration throughout the day. Things getting worse here. We're trading at around the lows of the session, off by about 1,260 points or give or take on the Dow. That's good for 3.25%. The S&P down about the same in percentage terms, being led lower by the Nasdaq, down 3.6%, as it's not really tariffs today that are pushing the needle, at least not directly. It seems to be the rhetoric that is heating up, mostly one-sided rhetoric coming from President Trump towards Fed Chair Jay Powell.
I think you're right. I think today, front and center, it's not tariffs, it's not earnings, it is Trump going after Powell is a big story because it is so public, Julie, and it's so personal, and it feels kind of relentless, and you know, he's late, he's a loser, he should be preemptively cutting. I think what you're really doing, and I think you see in the markets, is you're just constantly creating more questions and more uncertainty at a time when you already have plenty of drama and uncertainty. Because if you're investors, I think you're wondering what comes after this. And then you've heard the question, does he actually try to do something deliberately here to remove Powell? What would that look like? If he did, how would markets respond and react? And you see the red all across the screen today.
Yeah, one caveat I do want to mention when it comes to today's session is it feels quieter today. It actually is quieter. I was looking at the trading volume figures. For the NASDAQ specifically, trading volume is around 20% below the 100-day average. So there is a drop in volume today. That said, we are seeing the heaviest selling concentrated in large cap technology, all red here. We've got Tesla, of course, reporting its earnings tomorrow after the close of trading. The shares have really accelerated to the downside, off by 7% today. You've got Nvidia falling. That's after some reporting about Huawei developing a competing chip after new export controls were imposed on Nvidia last week. So all of that combining for a lot of selling.
Nvidia has not been working for a while.
Yeah.
We do have Bernstein and Stacey Razgon to come on. I think Stacey's still bullish on this one, so he's going to walk through the news and make the case. What is working today is gold, of course, continues to glitter.
Go back over there.
Yellow metal is up around roughly, I think, 30% year to date. Weaker dollar is, of course, part of that story. I did check in with our friend Mark Newton, smart chartist, get a technical take, and Mark told me, listen, he looks at the charts. He says still technically attractive here. Overbought, he said, but still technically attractive.
And we've been watching the dollar very closely as well. We're still seeing at least the dollar index continue to push a little bit lower today. As for yields, we got yields that are pushing a little bit higher today. So still a lot of big moves that we're seeing in the market. And investors' concerns, of course, are mounting with President Trump escalating insults towards Fed Chair Jerome Powell. He once again called on the Fed to cut interest rates, and this coming after Trump last week threatened to oust the Federal Reserve Chairman. Here with more on the rising risks, we have Apollo Global Management Chief Economist Torsten Slok. Apollo Global, we should mention, is the parent company of Yahoo. Torsten, fantastic to see you as always. Man, we got a lot to weigh these days in terms of potential risks to the economy, whether it's tariffs, some of the other geopolitical things going on, and now layer this potential threat about a removal of the Fed chair on top of it. As you're trying to weigh all of these risks, where do you put the risk that Jay Powell would be removed in terms of what that would do to the markets and the economy?
Well, first of all, thanks for having me, Julie and Josh. It's great to be here. So I think that the first immediate risk really is the impact of tariffs, especially the tariffs on China. We all agree that there is probably a need in some form or another to level the playing field with China. Democrats, Republicans have talked about that for a long time. And it is clear that the U.S., as the most open economy when it comes to tariffs, when it comes to non-tariff barriers, continues to, for years and years, have been open for the rest of the world. So the goal of trying to level set tariffs and level set global trade is something that I think really there's broad consensus is everyone agrees is a good idea. But the way that this has been implemented by imposing from one day to the other 145% tariffs on companies have, of course, meant that those companies that import goods from China, for example, your independent toy seller in Nebraska, your menswear store in Wyoming, your company that is selling, say, goggles and bought ski gear equipment in Colorado, they suddenly from one day to the other do not have the working capital to pay 145% more in tariffs. And that's why a lot of retailers, such as those I just listed, are likely going to go out of business if these policies continue. So to answer your question, Julie, I think that the problem is that the immediate risk is that small businesses are at risk of potentially being hit quite hard, because small businesses make up 80% of employment and 80% of CapEx spending. And that means that, yes, there are other risks, and certainly the threats to Jay Powell is another important development more recently, but the most immediate risk for the business cycle is the impact of tariffs on the small business world.
You say, Torsten, in a note recently, you say there's now a 90% chance of what you call a VTRR. Explain what you mean by that, Torsten.
Yeah, so if we really back up and think about normally, the economy is constantly faced with all kinds of what you could describe as shocks. For example, it was a shock that COVID came along, that created a recession. It was a shock when Lehman Brothers went under, that was a recession. We also had a shock in the early 1990s, of course, with the commercial real estate crisis, and we had a shock in 2000 when the IT bubble popped. So what is the shock today? Well, the shock today really is a voluntary trade reset recession. In other words, from one day to the other, a politician got elected. He comes in and says, I would like to start a trade war. And this trade war is now implemented in a way where we in financial markets can only conclude that it comes with more downside risks than if it was implemented in other ways. And it is mainly the implementation that is the biggest challenge when it comes to the economic outlook, namely that it comes with the risk that there is a requirement that, for example, your retailer who sells toys in the Midwest, who is now an independent store that normally has been importing from China and now needs to find other ways of getting these toys. And there is no easy, quick way to do that, because the same toys are not produced in the US. The same toys might not even produced in other countries. 75% of toys that are sold in the US, they come from China. So the conclusion is that the way that this unfortunately has been implemented is going to have a more negative consequences. And that is what we will call a voluntary trade reset recession. In other words, it's voluntary, it's a trade reset, and we are worried that there's a 90% chance now that this is going to result in a recession if these tariffs stay at these levels.
Torsten, what do you make of the argument about what the administration is trying to achieve in the end in terms of, as you say, they are resetting the trade paradigm on purpose. Is what they're aiming to do, A, is it achievable? And B, is it worth achieving?
Well, one important aspect, of course, is the discussion around the manufacturing sector only makes up today around 10% of US employment and 10% of GDP. It's been declining over the last many decades from around 40, 50%, if you go back to World War II, to now making up a much smaller share of the economy. So if the goal is to increase the manufacturing sector, then depreciating the dollar, of course, comes with another set of risks, as we, of course, are talking about in markets today. So the question here is it possible to grow the manufacturing sector? And if we want to grow the manufacturing sector, is that coming then with enough value added? For example, producing large language models, producing AI, of course, has more value added embedded relative to producing T-shirts and shoes and toys, etc. So there is some very fundamental questions around if you grow the manufacturing sector, and that is definitely possible. But is the cost that has to be paid to achieve that goal going to be significant in terms of what it might mean for labor that could otherwise have been spending hours inventing large language models, again, in AI and technology? So to your question, Julie, yes, it is a very important part of this discussion to debate whether the goal is to increase manufacturing, and if it's possible and desirable to increase the manufacturing sector. And if so, what type of products is it that we are imagining should be produced in the factories that potentially has to be built in this country?
Torsten, when the president went after Powell on social media, he did also talk about, of course, preemptive cuts by the Fed. I'm just curious what you make of that.
Yeah, so the challenge for the Fed is, of course, the following, namely that the Fed has a dual mandate. On the one side, they need to make sure inflation is 2%. On the other side, they need to make sure that growth is around 2%. And now with a trade war, we, of course, have that inflation is going to go up because tariffs makes things we buy in the US more expensive, and estimates from the Tax Foundation, the Peterson Institute, also from the Yale Budget Lab, point to inflation over the next 12 months going up about 1 percentage point. So if inflation is going up, the Fed should be hiking. But if at the same time growth is slowing, the Fed should be cutting. So which side of the dual mandate should you put weight on? And that's why this debate around what should the Fed do is so important, because the risk, of course, is that inflation is about to move higher because of tariffs. But if growth in the next several weeks, we could see potentially stores, including here in Manhattan, that will run out of goods that are no longer being imported from China. We could see supply chains getting clogged up. We could see, of course, a slowdown in tourism. We could also see inflation begin to move higher. So if growth is slowing and inflation is moving up, then the Fed will need to decide, is it time then to begin to cut interest rates? And they are saying in that dot plot that the next move is a cut. But the debate, of course, in markets is how quickly should they do that at the moment, especially now that the dual mandate is pointing in opposite directions.
Well, and the president has made clear where he stands on the issue. He seems to think the Fed should be doing it now, right? Or yesterday, or as soon as possible. The market in the first Trump presidency and even now sort of struggles with how seriously to take the president's various threats when it comes to things that affect markets and the economy. So I guess I would circle back to where we started, this question of how real is the risk that Jay Powell could be removed, or at least that there would be a fight to remove him. And I'm curious how seriously you're weighing this and how you even go about weighing it.
Well, there is one important point also here. Let's not forget that Jay Powell's term runs out in May of 2026. There's another FOMC member, Adriana Kugler, who will have to step down in January 2026. So we will probably, in any case, in the next 3 to 6 months, figure out who the next Fed chair is. So yes, of course, this debate is very serious about removing a Fed chair. That basically never happens really anywhere in the OECD area. But this debate is already getting to another point where, well, if we just wait another 3-6 months, then the Fed chair will already have to come to the conclusion that he is stepping down in May of next year, and we need to appoint someone else. So that's why markets, of course, need to figure out whether the firing of Jay Powell is an immediate risk or whether there is also a scenario, well, maybe we should just wait another, again, 3 to 6 months. And then we will, in any case, have a discussion around who the next Fed chair should be.
Torsten, always great to see you. Always great to have you on the show. Thank you, sir.
Thank you, Josh.
Tesla sick of day as a big first quarter earnings report now looms tomorrow after the bell. For more on what to expect from the EV giant, let's bring in Yahoo Finance's senior automotive reporter, Praz Subramanian. Praz.
Hey, thanks, Josh. Yeah, big earnings report on tap. As questions swirl around Musk and that cheap Tesla EV. As we all know, it's been a rough quarter for Tesla stock, down over 40% year to date. Q1 deliveries were a big miss, concerns about demand, and a lot of that is on CEO Elon Musk. His political activities like DOGE are sort of hurting the brand among people who disagree with his actions. And then there's the effect of him not being around, right, which sort of, some like Dan Ives are calling a code red situation that needs repair. Now for the numbers, looking at around $21.43 billion, just slightly higher than a year ago. Street also expecting around adjusted EPS of 44 cents a share, translating to adjusted net income of $1.57 billion. So that's all great, but the bigger questions are around Musk and the status of that cheaper EV now, which Reuters now says is delayed till later this year.
And so when we are listening to the conference call tomorrow, is that really going to be the focus, or should we still be focusing on things, Pras, like automotive gross margin that traditionally have also been something that investors zero in on?
Yeah, I'm sure they'll be looking at those metrics to see how the auto business is doing. But from what we hear from the analyst community, what we hear from people, investors, is the status of what is Musk doing? Is he going to return? Supposedly that May deadline for when special employees need to go back back out of the government. That's the big question: is what is Musk's status? And then, of course, yes, Julie, of course, that cheaper EV. Many have questions about when is that going to come out. That's what's to spur the next leg of demand and sales for the company. Because right now we're seeing those sales sort of lag, even with that new Model Y that just came out in March. Those haven't actually moved the needle just quite yet.
Pras, thank you so much. Appreciate it.
Thank you.
And Yahoo Finance is going to have special coverage of all things Tesla tomorrow. Coverage starting at 4 p.m. Eastern. We'll be getting you the results, speaking with analysts, and checking in on the earnings call. Don't want to miss it. Stay tuned. We got much more market domination still to come in the meantime.
Nvidia stocks sinking again today. This is coming after a report from Reuters saying China's Huawei is boosting AI chip production. For more now, we're going to bring in Stacey Razgon, Managing Director and Senior Analyst at Bernstein. Stacey, always great to have you on the program. So we have these reports. China's Huawei planning a new AI chip, they say, for mass shipment. It's from Reuters. I'm looking at Nvidia. We're down about 6% in today's trade, Stacey. You cover the name. What'd you make of that headline?
To be honest, I don't see why it matters. Nvidia's not allowed to sell anything in China anymore as it relates to AI, so who cares? Right? I mean, to be honest, this was my issue with the ban that we got last week on Nvidia's China offerings. They've already been heavily constrained by export controls. The part that they were allowed to sell in China, it was called H20. The performance was already very limited. And the parts that Huawei had available actually they have better performance. They're missing some other things, software compatibility, but they have better performance. After last week, then the government is now requiring licenses for Nvidia even to ship that low-end part. So effectively, they can't ship any AI parts into China anymore. So I mean, to be honest, we've basically just handed the China AI market to Huawei anyway. So like, I'm not surprised by any of this at all. And at least from where we're standing now, I don't know that it matters. Like I said, they can't compete anyways. They're not allowed.
I mean, so let's assume, Stacey, that policies are not permanent, right? And that you get a change in administration in a few years and things change again. Does this give Huawei such a head start that even if the policy changes, it'll give it a leg up? How are you thinking sort of longer term?
Yes and no. You have to remember the policies that were in place until last week were actually put there under the Biden administration, not under the Trump administration. And so that low-end part that Nvidia was allowed to ship until last week was already well below, Huawei's offerings. And frankly, I doubt that those thresholds were ever going to get raised. And so the gap between, what Nvidia was allowed to ship and frankly, the local capabilities was going to get bigger and bigger over time anyways. So no, I think we were going down this path as it stands. Nvidia has even talked about the China market gets more and more competitive. And you can even look at their sales into China. I think they did about 17 billion last year. It was probably about 12 billion in AI sales. That was the largest on an absolute basis that they've ever shipped. But as a percentage of their total revenue, was the lowest in over 10 years. Right. So China increasingly was becoming less important to them. They were getting decoupled because of the nature of these policies that were put in place. And again, it wasn't really Trump until recently. This was the Biden administration.
Stacey, you're just looking at shares of Nvidia back at the chart. We're down now about 30% this year. I mean, it's a whole lot worse than the NASDAQ 100. I know you're a believer, you're a bull on this one, Stacey. I mean, what is the catalyst that you think gets this one moving in the right direction again?
Yeah, I mean, this is the problem right now, because I do think it's funny, in the wake of all of the tariff stuff, I could argue that whereas tariffs and macro uncertainty, everything can cause real demand issues for a lot of markets, I actually think the AI demand has been real, right? So you could argue that will continue. I would also argue that, like, just from a pure hardware standpoint, given the nature of how everything is structured, the AI servers are probably a little less exposed to the direct tariff risk than some of the other end markets. They can come in through, most of the ones going into the US at least come in through Mexico, and they're compliant under the USMCA. They're actually tariff free. They're exempt from all the tariffs. So it's actually like fundamentally, it feels like AI should have a better backdrop than a lot of other end markets. But because of some of these policy, changes that have been put into place, and also just the broader worries about macro and everything else, they've been getting hit worse.
Well, and what about this sort of, there have been some reports bubbling up about some of the big hyperscalers like a Microsoft or Amazon today. There's an analyst report that they're considering sort of pulling back on some of that big data center spending. How worried are you about that?
Yeah, I mean, look, I actually don't think that spending this year changes very much. I think that what was in the books is going to be in the books. But look, there's been always worries that, like, are we at a CapEx peak? And a lot of people, even before all the tariffs, people were worried that, could 2026 CapEx come under pressure just because they were investing so much in 2025? They worry about a digestion. I mean, look, at the end of the day, they're macro exposed like everybody else. I mean, is it possible that CapEx could be down in 26 because of macro issues? Sure. Is that an Nvidia specific issue? Absolutely not. Like, look, if we go into a recession and the way things are looking, like, who knows? I mean, I think all bets are off, but I don't think that those are isolated necessarily to AI spending or Nvidia. I think those are broad risks. And look, the longer this goes on, I think the bigger those risks are.
A kind of a broader question I have for you, Stacey. The U.S. government, obviously, it imposes these export controls. We're trying to slow down Beijing's tech ambitions, chip ambitions. How effective do you think those export controls are going to prove to be?
I mean, they are and they aren't. So in the near term, does it throw up barriers? Sure. But at the same time, like the Chinese are not stupid, right? And we're forcing them down paths that maybe they would not have taken. Like I've said this before, but we're sort of forcing them to be creative in all senses of that word. And again, it's not just AI. It's AI. It's also semi-cap. It's analog semiconductors. It's all these things where there are increasingly like local domestic substitutes. And those substitutes, they are going to take more share than they would ordinarily deserve to take because they have no choice. They have to. And so, yes, does it slow them down? It probably does. But if I'm looking out, 5 years or 10 years, might we be faced with a more competitive China because they were forced to be creative, because engineers tend to do their best work when they're under constraints, and because they are not stupid and they have no choice? I wonder if we're opening up gates that maybe in hindsight we'll have regretted pushing them through. It's certainly possible.
So, Stacey, there's one question that I imagine many of our viewers want to know, and that is whether they should buy Nvidia right now, given all of this and given the drop.
Look, we still like the fundamental story. I like the story around AI demand. I still think that they are by far the winner in this space. But there's clearly like more uncertainty around everything. And again, like I said, it's not just Nvidia. Right. It's down a lot this year. The whole semiconductor industry is probably down, not quite as much, but almost as much as Nvidia. The sector's just gotten wrecked on all the tariff stuff. It's just one of the most global sectors that's out there, and it's both directly and indirectly, it's exposed and they get impacted. So my issue is right now, I don't know when all of this eases, but the thing is, it could ease tomorrow. It could ease literally with a tweet.
It could, although then another tweet will probably send it back down again.
Probably.
Such are the times we live in, Stacey. So hope you're doing lots of yoga or something. Good to see you.
You try to find it where you can, but like I have to put safe harbor like statements on my notes now. They're only accurate as of the time of publication. Like things are changing very quickly.
We are all trying to adapt. Thank you so much. It's great to see you as always.
You bet.
Thanks. Now time for some of today's trending tickers. We're checking in on Amazon, Salesforce, and Uber. Let's start with shares of Amazon getting crushed today. Raymond James downgrading the company to outperform from strong buy, while also cutting its price target on Amazon from $275 down to $195. In other news, Wells Fargo saying that Amazon's delayed some commitments around new data center leases. That's something I was just talking about. We asked Stacey Raskin about, and he said he doesn't think that spending plans are going to change much this year. But, beyond that, we could see if things change and what kind of effects as well with regard to Amazon the tariffs are going to have.
Yeah, we'll soon hear from those CEOs and the CFOs about some of these reports. What do they actually say, right? On this Raymond James downgrade, I'm on a scale of downgrades going from strong buy to outperform. I still really like it, just not as much.
Yes.
It's kind of the idea. I does think earnings could come under some pressure. They talk about tariffs on imports from China. They talk about investment intensity at the company. They do take the target to 195, which per Bloomberg, that is a street low. Your average target is more like 253.
Yeah, and by the way, when speaking of earnings, they are set to report on May 1st.
There you go.
So that's when we will get that commentary that we're
more insight on the way.
Yep.
All right, Salesforce in focus today. That's after receiving both an upgrade and a downgrade from Wall Street analysts. Shares are falling as D.A. Davidson downgraded the stock to underperform from neutral, lower the price target from 250 to 200. On the other side, Guggenheim raised its rating on the tech giant shares to neutral. D.A. Davidson, that would be the one and only Gil Luria, friend of the show. We like Gil. So he downgrades Mr. Benioff's company to underperform, so equivalent of a sell. Neglecting its core business, he says, to pursue a premature AI opportunity. He says, yes, he told his clients Agent Force does make strategic sense, but betting the whole company on this effort may be at the expense of the other 98% of the company's business. Also, I thought it was interesting, he did his checks like the good, responsible analyst that he is there. And Gil says he did his checks on Agent Force and said many of the customers do not have the appropriate data stack, nor do they have the confidence in the ROI, especially given the evolving price models.
Well, guess what? There's another analyst who's on the other side of this trade today. And that's John DiFucci, another smart analyst over at Guggenheim. Now, much like him being, the other analyst on Amazon, we were discussing less bullish, but still bullish. This is not a pounding the table buy by any measure. DiFucci is upgrading this to neutral from sell when it comes to Salesforce and removing the price target. They said the stock fell to their prior price target. And so basically the valuation now looks less unattractive, I guess, You won't say it looks attractive, but it looks less unattractive here. And so now they're saying that some of the changes that we've seen also in the dollar might be more positive for something like a Salesforce.
I think you got to get him on here for a good old-fashioned, I guess, sell versus neutral debate, although that's not as dramatic. But still, those would be two analysts.
Yeah, a little debate. And the Federal Trade Commission filed a lawsuit today alleging that Uber, a rideshare and delivery giant, was charged consumers for its Uber One subscription service without their consent, as well as failing to deliver promised savings, and made it difficult for users to cancel the service despite its cancel anytime promises. Now, this is interesting on a number of different fronts, right? Do you have Uber One?
I don't.
I don't have it either.
No.
Not, at least not that I know of. But, this is sort of traditional FTC bread and butter, right? Saying that companies make it too hard for you to cancel a subscription. But this is another signal that the FTC is sort of business as usual in some respects, including a case like this.
Yeah, this administration continues to go after big tech. Google, Meta, you got Uber. Maybe not terribly surprising. I mean, Trump often did talk about, I used to say he liked little tech, didn't love big tech, it sounded like. Uber, by the way, does have a statement out. They did tell Bloomberg, Uber One sign-up and cancellation process is clear, simple, and follow the letter and spirit of the law, that Uber does not sign up or charge consumers without their consent. Cancellations can now be done anytime in the app and take most people 20 seconds or less. So they're fighting back, it sounds like.
Yeah, sounds that way. Well, stocks are sinking today with tariff concerns top of mind. For more on where investors should be focused amid the uncertainty, let's welcome in Troy Geski, FS Investment Chief Market Strategist. And by the way, FS, an alternative asset manager with more than $80 billion in assets under management. It's good to see you, Troy. It is obviously a tumultuous time in the markets here. I mentioned tariffs in the intro, but now you also have the contention of a potential conflict between the Fed Chair Jay Powell and President Trump to layer on top of that. What is sort of the top concern that you're hearing from clients right now as all of this is going on?
Yeah, great to see you, Julie. And, as we discussed before coming on the air, I'm really glad that we're focused on the alternative asset management business, where you have obviously far less volatility in these uncertain times. But, I think the main point to remember, as we discussed today, which I've made the past, 6 weeks, is that, you really never had a president or a cabinet that's been willing to run a reasonably high risk of a recession, and we already have had a bear market, in order to achieve trade goals, right? As noble as they may be, that's a very big risk to run, and you're seeing the market reaction. And, you can kind of think of this a variety of ways. Our favorite kind of comparison is to 2022, which was the original galactic mean reversion. A lot of the forces that had driven equity prices well in excess of corporate profit growth and nominal GDP growth had been reversed. And one of those forces was lower interest rates. Interest rates went up a lot. The other was the Fed printed money like crazy, and then the Fed started to constrain money supply. This time around, though, it's caused by really a full-on assault on those that benefited the most from globalization, which have been primarily been U.S. multinationals, which make up the largest market cap in the world in U.S. markets, as well as our trade partners, which certainly in some ways took advantage of us, but they were playing by the rules that we established as a country. So the point there is, when you think of the pain that we've had so far, which is certainly, if you've had too much beta coming into this environment, it's been very painful. It's going to take quite a long period of time to sort out, because corporate profit margins were expected to increase from 12% to 13% this year, which always seemed pretty crazy. And now there's a realistic probability they compress, and we get flat earnings growth or no earnings growth, even if we can avoid recession.
Troy, today, it did not seem like tariffs or earnings were front and center for investors. I mean, really what seemed to be front and center, it was Trump going after Powell very, very publicly and very personally. He's late, he's a loser, they should be preemptively cutting. I'm just curious, I mean, you saw that. Do you think Trump could really try and make a definitive, deliberate move here to get Powell removed? And two, if he did do that, Troy, what do you think the response and reaction of the markets could be?
Yeah, so I think oftentimes there's a lot of rhetoric that comes from the president that he fortunately doesn't follow through with. That being said, to your point, what's exacerbated this downturn, right, is you've had all these flows of capital that have supported U.S. markets internationally really go in reverse at a very rapid pace. You think of how much the dollar's weakened versus the euro as an example, which, the euro was up super strong today, over 1% versus the dollar. You think of the ugly price action at the back end of the yield curve, the 10-year and 30-year Treasury bonds are getting slaughtered again today. And again, if you're selling U.S. assets and you're moving them overseas, you only have deep liquid market choices, which of course bring you back to the Magnificent Seven, listed equities on the NASDAQ or in the S&P. And so both the dollar, the bond market, and equity markets are taken on the chin, some of which was undoubtedly exacerbated by the comments directed at Chairman Powell.
So, Troy, let's talk a little bit more about alternatives. And there's sort of this rising drumbeat recently, especially from some of the private equity giants, that folks should change their allocation and sort of away from 60-40 and maybe do 40-40-20, for example, 20% alternatives. But as we know, alternatives is a big bucket.
So, yeah, that's for sure. Yeah.
So I'm just curious, when we're talking about alternatives, for people who are not as familiar, at a time like this, if your argument is that this is a good time, I imagine you always say it's a good time to be in alternatives, but if now is a specifically good time, why?
Come on, Julie, I'm a straight shooter. Come
That's
on.
true. That's true. I give you credit. So, but if that's true, why and where within alternatives?
Yeah, so I think when you step back, there's actually four buckets, but I'll just focus on two for the audience today. One would be private equity instead of public equity. So, public equities, the S&P, for instance, about 40% of its revenue comes internationally, and some of that revenue is challenged right now, not to mention, some of the assaults on profit margins. In the U.S. middle market, which makes up about a third of private sector GDP, which would be the third largest sector in the world, or third largest economy in the world, U.S., China, then the U.S. mid-market, 86% of the revenue comes domestically. And the vast majority of those companies are service-oriented, so they have far less, pressure on their inputs from the tariffs than, say, a classic manufacturing company would have. And the interesting thing about middle market private equity in particular is coming into this dislocation, valuations had not appreciated at all in lockstep with the S&P or the Russell 2000. So there should therefore be much less, if any, downside in valuations since they're pretty much stuck at the bottom. Furthermore, revenue growth is typically, let's call it 3 or 1.5 to 2.5x that of the U.S. nominal GDP. So even though we're going to get lower nominal GDP growth this year, barring an apocalyptic recession, which we don't expect, you should still have positive revenue growth and some degree of earnings growth, even in a tough market. So if you're solving for growth and you're trying to solve for that growth at a reasonable price, middle market private equity continues to shine like a beacon of light in an environment where you've either had to pay a lot for growth and you're now taking it on the chin, or you just couldn't get growth at all. So that's one example, Julie. Happy to get into private credit as well, if I have time.
I think we got to leave it for today, but we will save private credit for another day, I assure you, Troy, and we'll have you back to talk about it.
Thank you so much, Julie. Have a great rest of your day.
Great to see you.
Let's get a quick check of the markets right here as we're counting down to the closing bell on Wall Street. Bottom line, you got red across the screen. We have the Dow down 1,100 points. Your broad gauge, the S&P 500, it looks like we're down about 2.7%. I'm just looking quickly at the NASDAQ. Tech-heavy NASDAQ's down 3%. Of course, all that coming as we know, President Trump again going after Powell on social media, very personally and very publicly again. Stick around, much more market domination. That's still to come.
Welcome back to Market Domination, sponsored by Tasty Trade. Let's do a quick check of the markets here. Not seeing much relief, a little bit of a bounce off the lows, but still the Dow down by almost 1,100 points, almost a drop of 3%. The S&P 500 down about the same, and the NASDAQ down about 3% as we see the selling continue here today. Taking a look at the bond market as well, we've been watching the 10-year pushing higher again today after jumping last week following Fed Chair Powell's comments on tariff uncertainty and more tension brewing with President Trump venting his frustrations with Powell on Truth Social this morning. For more, bringing in Chip Huey, Managing Director of Fixed Income at Truist Wealth. Thanks for being here. We have been trying to sort of sort of suss out what people are thinking today about how realistic it would be, how far President Trump is willing to go to try to remove Jay Powell as Fed chair. How are you thinking about that, and do you think the market is even sort of considering pricing in that kind of a scenario?
I do. I think it's hard to say, obviously, how it plays out, and obviously this has been in a very public forum that we have seen that. But I do think that today's market reaction does suggest that the market does really, really value an independent Fed, one that's focused on the dual mandate, which Fed Chair Powell seemed very committed to last week. I think that's still a very important priority for the market. And today's volatility that we're seeing, I think, supports that notion.
And Chip, also relevant, of course, in your universe is Trump's tax plan. We talked to U.S. Treasury Secretary Scott Bessent last week. This is his outlook. Take a listen.
So the tax bill is moving through the Senate, moving through the House. I think we're going to have some permanence for the 2017 Tax Cuts and Jobs Act, probably by 4th of July.
So, Chip, I'm just curious, what are your thoughts? You hear that on the impact of all this bill on yields?
Yeah, I think it's certainly a situation that we're monitoring. I don't think that the market is too focused on that yet. It's still focused on this back and forth from a tariff standpoint. I do think that there's some effect of some flows going away from U.S. assets into areas like Germany, Switzerland, Japan, into areas like gold. I think that's really what you're seeing. Now, that could change. And once we get a little bit more detail on that tax plan, it will have implications potentially for deficits. What does that mean for our debt supply outlook? That when that moves into the spotlight, then you could certainly see more tax-related reactions within the yield curve.
And Chip, when we talk about where funds are sort of flowing here, we know that people are getting out of stocks, or at least lightening up on stocks. But it's not clear that they're going into treasuries, right? Because we've had this sort of back and forth price movement there. So where are those funds going? Are they going into cash? What are you seeing?
I think some are going to cash. Some are going to other international safe haven type areas. I will say that the front end of the U.S. Treasury yield curve has been remarkably resilient. It's actually been very stable based on the expectation the market is pricing in is about 3 or 4 rate cuts this year. That's been pretty stable. I think where there's more trepidation is taking on a lot of long duration, right? A lot of long dated fixed income exposure way out the curve. That has been more hesitancy there. But I do think that whether it's cash or whether it's with a little bit less interest rate exposure in the front of the curve, you're still seeing some interest there in the U.S. Treasury market.
Chip, kind of just a broader policy question. You look at the 10-year here, so 4.42. Chip, when you listen to Bessent and the administration, the policy goal here they talk about a lot, Chip, and you've heard this, is get those rates down. Do you think their policy mix, as it stands now, Chip, is that the right policy mix to achieve that objective?
Well, I do think it's powerful when you talk about getting the 10-year down, right, and also getting oil prices down, which has an inflation, a disinflationary effect, which can put downward pressure on yields. Just jawboning it and talking about it, does help. I think that what we need to do in order to achieve that is likely get through this period of uncertainty, get some clarity on the policy front, and then I think it becomes much more achievable. The concerns about, hey, is there going to be an inflationary impact? How sustainable, is it based on tariffs that are put forth right now, which the market also feels like could really change minute to minute. If we can get some more stability there and a little bit more clarity, some reliable information on where we're headed, I actually think that it's still achievable.
Chip, great to have you on the show today. Thanks for joining us.
Thanks for having me.
Shares of Chipotle fallen as the market sell-off accelerates. The company set to report first quarter earnings on Wednesday. For more, we're bringing in Yahoo Finance's senior reporter, Brooke DePalma. Brooke.
Yeah, good afternoon to you both. Chipotle results expected to be a bit overshadowed here, of course, by those President Trump's trade war. It certainly is leaving Wall Street wondering the impact on both Chipotle's cost of goods as well as the impact on consumer behavior. And if you take a closer look at the numbers, we are still expected to see a ever so slight year-over-year increase for both adjusted earnings per share as well as revenue. But same-store sales growth far lower as well as expectations go than what we saw last year. Same-store same-store sales expected to grow nearly just 2% in this environment as consumers are perhaps pinching a bit of their wallet. Traffic growth expected to see a modest decline for the first time since 2022. Now, higher average check could offset that a bit. We are expecting to see a bit of an increase when it comes to the average check size, roughly an increase of 2.69%. Now, some key things that investors are watching for here includes the performance of that LTO offering, that honey chicken protein offering they had. It had a great test run, but Wall Street certainly does not think that it played out as well as it did in the test run. Also, guidance for 2025, the company previously said that they expect same-store sales to increase in the low to mid-single-digit range. And of course, President Trump's tariffs are expected to be top of mind for Wall Street going into this report. We know that about 2% of sales, of Chipotle sales, are sourced from Mexico. That includes half of Chipotle's avocados. It also includes other ingredients like tomatoes, limes, and peppers. We know that right now, most of produce coming from Mexico is exempt under that United States-Mexico-Canada agreement. Tomatoes into the summer will go off that exempt list. We also know that they have diversified so much of their sourcing of avocados now are coming from the Dominican Republic, Guatemala, Colombia, Peru, as well as Brazil. And so perhaps as they diversified where they were getting their avocados from, now the 50% that they're getting from Mexico's are exempt at this very moment.
Well, and speaking of diversifying, now there's a report that they are diversifying geographically as well. They're planning their first location in Mexico, right?
In Mexico, exactly. And they're planning to open up one location, as far as we know, with Alci. It's a restaurant operator that's primarily known in Latin America as well as Europe. That's expected to open in early 2026. And then the idea is that they'll sort of assess where they go from there. Alci, known to have other franchise models in Mexico, including Domino's, Starbucks, Burger King, Chili's. So certainly one to watch. This is not the first international expansion for Chipotle. We know that they expanded in the Middle East back in July of 2023, partnering with another restaurant operator there, but certainly something to watch. I mean, expanding internationally during this time, definitely an interesting move.
Yeah, and it's also interesting, aren't most of their locations, especially in the U.S., owned by and operated by Chipotle itself,
Company owned,
right?
exactly.
Yeah.
So this is a new business model that they're certainly testing the waters on here, but all company owned in the U.S. They also have long-term goals to have 7,000 locations in both the U.S. and Canada. Right now, they have about 3,500.
Oh, doubling. All right. Thank you so much, Brooke. Appreciate it. And tune in on Wednesday. Yahoo Finance will be interviewing Chipotle CEO Scott Boatwright at 4 p.m. Eastern. Stick around. We got much more market domination still to come.
The U.S. dollar sank while gold futures touched new records after Trump warned in a post on social media of a slowing of the economy. Our next guest today says that gold and the dollar have a complex, often inverse relationship. For more, let's welcome in now Kenny Polcari, Slatestone Wealth Chief Market Strategist and host, of course, of the Yahoo Finance podcast, Trader Talk. Kenny, great to see you.
Always a pleasure. Thanks for having me.
Let's start with gold, which continues to shine.
Right.
I was talking to Mark Newton. I checked in with Mark over at Fundstrat, the very smart chartist technician, and I said, technically, what does it look like to you? And Newton said, it's still attractive. He said overbought, but technically he still said attractive.
I agree. I mean, if you look at it on the chart, it goes straight up. I mean, it's up 25%. It was trading at 2,700 in January. It's trading at 30. We traded another century mark today, right? 3,400. So it's up $700 in 4.5 months. So yes, it's straight up, but I think it just screams uncertainty and nervousness and anxiety. And so that's the move. I still like gold as well, but I wouldn't be surprised if we get one good headline that suddenly you might see a quick reversal in it, but I still like gold in the long term.
And then could have a quick reversal in the other direction,
100%,
which is what we've been seeing
depending
recently.
if right.
Yeah.
The headline from minute to minute.
Right. And of course, as we said in the intro, the gold and the dollar tend to have this inverse relationship, and the dollar has been down. So do you expect that move to continue also?
Yes, I think if the dollar continues to get weaker, look, we breached 100 today on the dollar, right? So now we're trading below that. So as the dollar continues to get weaker, it'll just, commodities are priced in dollars, gold's a commodity, so a weaker dollar will allow gold to go higher, right? As it will other commodities. But in this case, I think if the dollar continues to weaken, then I think that's just more fuel for gold, because a weaker dollar is just going to continue to cause nervousness and angst in investors and about the economy, and so therefore they'll run into the ultimate safe haven play, which is gold.
Let's talk more broadly and look at the SPX. So we're down right now about 2.5%. 51.49. What are the levels you're watching?
So I'm really looking for us to test the lows that we made, 48.35, right? So I fully expect at some point we're going there. So between here and there, I'm just waiting for it to see it 48.35. I think it'll hold there. I'm not necessarily saying we're gonna go there, but I wouldn't be surprised if we do. But anywhere in here, look, down at the 5,000 is kind of the big round number, right? So if you ask me a number right in line, I'd say 5,000. But I really think 48.35. I think it's got the potential to test it. And if we keep getting headlines like we're getting today, the negativity and the nervousness and calling Jerome Powell names and telling them to cut rates and I'm going to throw you out, I wouldn't be surprised if we test it fairly quickly.
Kenny, it's so interesting, this whole Jay Powell stuff. We talked earlier to Troy Geski over at FS Investments, and we were talking about this idea of how seriously to take the president when he says stuff like this. And I think we were in an environment where people, before this current term,
right,
where people sort of discounted. They said, oh, he's going to say what he's going to say, and he's not going to do the stuff.
Right.
But then tariffs came.
Right.
And people said, oh, maybe he is going to do the stuff. So how do you overlay that on this Jay Powell commentary?
So you don't, and that's what bothers me a little bit, because I think there has to be a definite separation between church and state, right? Between the White House and the Fed. There has to be. And the fact that he's throwing it out there and he's maligning him and calling them names and threatening to throw them out is only adding more chaos to an already chaotic situation. So I'd like to think that Powell's not going anywhere, that, if he's asked to resign, he says no, that he serves out his term. I don't think it's going to be very easy. If Trump really wants to throw him out, I think he's going to have to start jumping through hoops to do it. I don't think it's going to be that easy to do it. But in the end, I think Jay Powell, in this case, I think he's right. I don't think there's any reason to cut rates right now. I don't think the macro data suggests it. The soft data, some of the data, the soft data might be suggesting a little bit of concern, but the hard data is not suggesting that to me yet. So I think Jay Powell's right in holding it steady in light of everything that's happening, tariffs and the chaos and the uncertainty. And look, you and I both know this too. The market can price in bad information as well as it can price in good information. But it's this uncertain stuff every day that is creating this chaos, and people just say they're tired of it and they throw it out, which I think obviously also is not the right thing to do, right? Getting emotional in your trading or your investing, especially if you're a long-term investor. If you're a day trader, you love this chaos because you want it to go up and down more often, right? But as a long-term investor, you really want to kind of, you need to stay the course, and you just need to make sure that the names you own, the thesis on why you originally bought them continues to be the thesis why you want to own them.
Right.
Kenny, always great to see you, my friend.
Always a pleasure to have me. Thank you very much.
And be sure, of course, to tune in every Wednesday at 12 p.m. Eastern to the Yahoo Finance podcast, Trader Talk, hosted by Kenny Polcari. You can scan the QR code below to stay up to date with the latest content. And while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.